In January 2021, a digital rebellion sent shockwaves through Wall Street. This wasn't merely a stock market anomaly, it was a seismic event. An army of retail investors, galvanized on online forums, orchestrated a historic short squeeze against institutional titans. The target, GameStop, a struggling brick-and-mortar chain whose stock price rocketed from under $20 to nearly $500 in days. At the storm's heart sat hedge funds like Melvin Capital, betting billions on GameStop's demise through short sales. They believed the company was a sure thing to fail, but the internet had other plans, turning a bearish bet into catastrophic liability, forcing them to cover positions at astronomical losses. The initial fallout was immediate and brutal. Melvin Capital hemorrhaged billions, needing a $2.75 billion bailout from Citadel and $0.72 to stay afloat. This wasn't just abstract numbers. It was real capital vanishing, exposing vulnerabilities few had anticipated in the market's perceived stability. Then came the controversial move. On January 28th, trading platforms like Robinhood restricted purchases of GameStop and other meme stocks. Retail investors felt betrayed, their rallying cry of democratizing finance suddenly silenced. Was this market manipulation, or a necessary evil to prevent a wider collapse? The question of fairness was now front and center. The restrictions sparked outrage, leading to congressional hearings and intense scrutiny from the SEC. Lawmakers grilled CEOs demanding answers about market mechanics and potential collusion. The event laid bare deep-seated questions about the integrity of America's financial infrastructure and who truly benefits when the system is stressed. The less understood reason behind Robinhood's actions lay with clearinghouses. As GameStop's price soared, these intermediaries demanded billions in collateral from brokers to cover potential losses. Robinhood, lacking sufficient capital, had to halt trading to meet these margin calls, revealing a critical, often invisible, choke point in the market's plumbing. The GameStop saga profoundly impacted market awareness. It shone a harsh light on payment for order flow, the controversial practice where brokers sell customer orders to market makers. It also fueled a new generation of retail investors, more informed and emboldened, poised to challenge traditional power structures. The debate over market fairness continues. Ultimately, the GameStop short squeeze was more than a financial anomaly. It was a potent symbol. It exposed the fragile interconnectedness of our financial systems, the latent power of organized retail investors, and the uncomfortable truths about who holds the reins of the market. Its echoes still resonate, a stark reminder of systemic vulnerabilities. If you're curious about other moments when market greed exposed systemic flaws, watch our deep dive into the 2008 financial crisis next.